Aloha students, Brother Nemro here again, and this is the solution to brief exercise 2-8. Let's go ahead and read the problem. Osborne Manufacturing uses a predetermined overhead rate of $18.20 per direct labor hour. This predetermined rate was based on 12,000 estimated direct labor hours and $218,400 of estimated total manufacturing overhead. Now, wasn't it nice that they already calculated the predetermined overhead rate for you? I probably won't be that generous on the exam. So let's just make sure that we understand how to do it. The predetermined overhead rate, I gotta get my pencil working just a moment. The predetermined overhead rate is calculated as total estimated overhead cost divided by total estimated allocation base. In this case, what's our allocation base? It tells us right here, direct labor hours. So we know that in our numerator is going to be a dollar amount, and our denominator is going to be direct labor hours. So now can you fill those two in? What's our estimated total overhead cost? Right here, $218,400. And our total estimated direct labor hours, that's 12,000. So our rate then would be $18.20 per direct labor hour. Don't you feel better now that we calculated that and confirmed that that is, sorry, so much for my straight line. That is the correct predetermined overhead rate. Okay, let's finish reading the problem. The company incurred actual total manufacturing overhead costs of $215,000 and 11,500 total direct labor hours during the period. So that sentence gives us all the actual information. So you realize that the predetermined overhead rate is calculated at the beginning of the year before we've done any work. We don't have any actual data at the point we're computing the predetermined overhead rate. The actual data comes to us later in the year. So now we're on requirement 1. Determine the amount of underapplied or overapplied manufacturing overhead for the period. And you guys know how I love T accounts. Let's use our T account. Manufacturing overhead T account. And you remember what always goes on the left-hand side of the manufacturing overhead account? You may say that's where the debits go, Brother Nemro. That's very good. Debits do go on the left, but what does it mean in terms of manufacturing overhead? That means we're looking for actual manufacturing overhead to be recorded on the left side, the debit side. I keep pointing my head this way because that's the way it looks on my screen to you. It's that way. Sorry. What goes on the right side? The right side? Applied. Yes, it's also credits. But I want to focus your mind on the idea of the applied. So let's put the numbers in. What's our actual manufacturing overhead for the year? Did you find it in the problem? It's the second sentence right here. $215,000. That's our actual total manufacturing overhead cost. So let's put it in. $215,000. How about applied? Do you see the number? You have to calculate the number. Do you remember how to calculate applied manufacturing overhead? you say, well, we need to use the predetermined overhead rate. That's right. That's why we calculated a predetermined overhead rate, so we can use it to apply overhead. So let's begin with our $18.20 per direct labor hour. And we're going to multiply that by something. Do you know what we're going to multiply it by? Actual total direct labor hours during the period. So this is where we need actual direct labor hours. 11,500. So the overhead is applied throughout the period based on our predetermined overhead rate. Better calculate that with the machine here. 209, 300. Is that what you got? I think that's right. So now how do you answer requirement 1? Determine the amount of underapplied or overapplied manufacturing overhead for the period. Right. We simply need to calculate the balance in our manufacturing overhead account. Do you know what the balance is? Well, it's $5,700. That's the difference between those actual and applied overhead charges. But is it on the left side or on the right side, the balance? It's got to be on the left side because that's the higher of the two numbers. We have a $5,700 debit balance in our manufacturing overhead. Is that underapplied or overapplied overhead? It's a good test for you. Well, if you just look and read to yourself, we applied less than actual. If we applied less, that means we didn't apply enough, underapplied. So anytime you have a debit balance in your manufacturing overhead account, you can say that is underapplied overhead. If the applied number happened to be larger than the actual number, then we would have had a credit balance, and we would call that overapplied overhead variance. Part 2. Assuming that the entire amount of the underapplied or overapplied overhead is closed out to cost of goods sold. Do you know what that means? Closed out to cost of goods sold. Remember, this account, manufacturing overhead, is not a typical account. It's a suspense account, a temporary account. We have to close it before we can prepare any financial statements. How do you close it? Closing it means you make it a zero balance. When we're all done, we want to have a zero balance in this account. So how do you go from a $5,700 debit balance to a zero balance? You need to credit the account for $5,700. Then you have a zero balance. All of you have taken accounting classes long enough to know that if you credit manufacturing overhead, you have to debit something else, or the world is not right. So I'm creating an account with a debit of $5,700. What account is that? It told you in the problem. Cost of goods sold account. Good old cost of goods sold. Okay? What would be the effect of the underapplied or overapplied overhead on the company's gross margin for the period? Gross margin? Do you guys remember what that is? Think of your income statement. The top part of your income statement, sales minus cost of goods sold, gives us gross margin. Then we go on to finish the income statement with net income, but we'll focus on gross margin at this point. First thing you have to figure out is, did this debit to cost of goods sold increase cost of goods sold or decrease cost of goods sold? Do you know how to determine that? What's the normal balance of the cost of goods sold account? It's a debit balance. That's what we expect cost of goods sold to normally have, a debit balance. It's an expense account. Expense accounts have debit balance. So if we add a debit to cost of goods sold, that's going to increase our cost of goods sold for the period. So if we increase cost of goods sold in this format, what's going to happen to your gross margin? Remember, cost of goods sold is subtracted from sales. So if you increase cost of goods sold, you're going to decrease your gross margin. Can you handle that? I hope so.